The biggest investing mistake isn't buying the wrong stock, it's selling the right one too early. And I'll give you a famous example to prove it. But first, when should you actually sell a stock? I'm Edward Kalstien, founder of Egg Capital, where we look for market-beating stocks for the long run. And in this Back to Basics episode, we're covering one of the most misunderstood questions in investing. When should you sell? Because buying gets all the attention, but selling is what ultimately determines your returns. Let's go through the rules, and the first and most important reason to sell a stock is simple. Your investment thesis no longer holds. Maybe the company loses its competitive advantage. Maybe management changes direction, or maybe the industry itself deteriorates. If the reason you bought the stock no longer exists, the position needs to be re-evaluated. Great investors constantly ask themselves one question: knowing what I know today, would I still buy this stock? If the answer is no, it might be time to sell. The second rule comes up if there's a clearly better opportunity. Investing is always about opportunity cost. Your capital is limited. If you find a significantly better business with higher returns, stronger growth, or a wider moat, reallocating can make sense. But this should be rare. Constantly trading in and out of positions usually destroys long-term returns. The bar for selling a good business should be very high. The third rule comes up when risk becomes too high. Sometimes the fundamentals remain intact, but the risk profile changes. Examples include excessive debt, structural disruption, regulatory pressure, and poor capital allocation. When risk permanently increases, expected returns fall. That's a rational reason to reduce or exit a position. The fourth rule is valuation, and this is the most common reason investors sell. But it's also the most misunderstood. A stock looking expensive does not automatically mean you should sell. Some of the best companies in history looked expensive for years. Selling purely based on valuation can be a costly mistake. And NVIDIA is a great example. In March 2022, NVIDIA was trading at a forward price-to-earnings ratio of roughly 90. The stock price was around $20 split adjusted. Many investors looked at that valuation and concluded the stock was wildly overvalued. If someone had sold based purely on that metric, they would have missed an almost 10x increase in the following years. What looked expensive at the time turned out to be the early stages of massive growth. This is why valuation should never be viewed in isolation. The real question is the business improving faster than the valuation suggests? If the answer is yes, holding often beats selling. Now let's finalize by giving you a better selling framework. Instead of asking, is this stock expensive? You should ask, has the business quality deteriorated, or has the growth structurally slowed? Has risk increased, or do I have a clearly better opportunity? If none of those are true, the best decision is often to do nothing. And doing nothing is one of the hardest skills in investing.